There are all sorts of ways to invest. The options out there are endless, but finding the right one for you, that's the ultimate challenge. We've all learned how to study hard, get good grades, and land a good paying job, right? But with investing, our school doesn't teach us, and in fact, no one will teach us for free because it's a very lucrative and high value knowledge. But don't worry, I'm here today to do just that. So first things first, investing is about putting your money into assets like stocks, real estate, commodities, etc. And you're essentially owning a piece of a productive asset, like being a co-owner of a business where your money is now working for you even when you're sound asleep. And that means you are no longer just selling your time with a 9 to 6 employment, you are making your money work for you as well, and that will definitely accelerate your process towards financial freedom. And this is a very important concept because most rich people leverage their money and all the available resources to them instead of selling their own time hour by hour by hour. More about that in the future episodes, but anyways, to put things into perspective, just in case you are totally new here, don't worry, no one will judge you here. Let's first distinguish between saving and investing. When you put money in a savings account, for example, you are essentially saving, and this is often seen as a low risk approach since your principal amount, or your money in this case, will never decrease unless you withdraw it, of course. However, the interest rates or the small bits of money that the bank will pay you periodically on your savings account or even your fixed deposits are relatively low, if not almost zero. Say you're earning a 0.5% interest rate in a savings account, or maybe even 3% in a fixed deposit account. So a $10,000 deposit over the course of 12 months will only earn you about $50 in a savings account or about $300 in the fixed deposit. Sounds okay, right? But here's the catch. Saving is not the same as investing. With investing, like I've said earlier, you are putting your money into productive assets like stocks, bonds, or real estate with the expectation of a more substantial growth over time. And when I say substantial, that number can go as low or as high as you want, depending on the investment asset you are going for. And this growth potential helps fight the effects of inflation and also currency depreciation, which are often overlooked by easily 99% of the people out there. And to give you another context, over the past 10 years, my beloved nation's Malaysian ringgit depreciated against the US dollar so much that the value of 1 ringgit in US dollar terms has decreased by approximately 12.9% over the past 5 years, meaning Malaysians are automatically losing 12.9% of their buying power over the period without them realizing at all. And that, my friend, is very, very scary. My point is, with investing, you are almost in full control of how much you want to grow your money and not just be fixed with this 0.5% or 3% rates and at the mercy of your nation's price inflation and also currency depreciation. For example, let's look at investing in the S&P 500, and you might be wondering, Ziet, what is that? Well, to put it simply, it's an index, a kind of benchmark that represents 500 of the largest companies listed on the stock exchanges in the US. For example, Apple, Microsoft, Google, Amazon, Tesla, Meta, etc. And when you hear that investors in the S&P 500 have made a profit, it means that on average, the value of these 500 big companies has grown. And even legendary investor Warren Buffett mentioned that S&P 500 is the best investment for most people. Why did he say so? Well, if you had invested $10,000 in S&P 500, say 10 years ago, today in 2024, without adding any money in between the period, that initial investment could have grown to well over $19,500 by now. And that, my friend, is the power of investing. But of course, I'm not trying to tell you that stock investing is the only way to grow your money. That would be very biased of me. You can pretty much invest in a lot of other assets too. Take real estate for example. They have their own success stories as well. In fact, here in Malaysia, if you had bought a property in KL pre-COVID times, your house prices would have inflated around 8% per year, and post-COVID, that inflation stands around 4% per year. Not as good as before, but my point is, housing prices are getting higher year after year after year. Unless there's an economic disruption or oversupply, then that's a different story. And of course, as with every investment, it comes with its own nuances. A good property investor would also take into account all the shadow costs like interest costs, maintenance fees, lawyer fees, etc. etc. You get my point. And then there are also people that have invested in stocks very early on and they made a huge fortune with the tech giants like Nvidia and also Tesla. And it might seem easy or lucky to be them today, but they took their chances back in the early days where those investments had a crazy high risk profile. And it's easier for us to say to invest in successful companies now compared to back when they were just a small company. Anyways, my point is, with the right investment made at the right time, with the right research, you might have just invested in a gold mine that can grow exponentially, sometimes 10x, 20x or even more. Of course, it's not always a smooth ride. There are years like 2008 and 2022 even where the stock market just went downhill and investors lost about 20 to 40% of their fortune during those times. But if you zoom out and look at it in the bigger picture, investing will again reward you over the long run. So let's take it one level deeper. How do we start investing? Well, let me start by giving you a bird's eye view on the various investment assets you can consider for yourself, even if you are a total beginner that knows nothing. One of the most popular investment options, no surprise, is stocks. And when you buy or invest in stocks, you are essentially buying a piece of a company's ownership. So if the company does well, your stock increases in value and you get richer. But how exactly do you make money from stocks? There are two main ways: dividends and capital gains. Let's start with dividends. Some companies pay out a portion of their profits to shareholders and we call that dividends. Think of it as a reward or bonus that the company gives you for investing in them. And these payments are normally made quarterly, once every 3 months or 4 times a year. And the amount, of course, depends on how many shares you own in the company. For example, if a company pays a dividend of $1 per share and you own 100 shares, you will receive 1 times 100, $100 in dividends before tax. Simple maths, right? But of course, not all companies pay dividends, while the ones that do can change the dividend amount depending on their profitability and other factors like cash flow, debt and economic conditions. So it's never a guaranteed thing when it comes to that, just like your company's bonus, right? And the other way would be capital gains, where you sell your stocks for more than what you paid for it. For instance, if you bought a stock at $50 per share and later on you sold it at $70 per share, you would have made a capital gain of $20 per share. But here's the kick: capital gains are realized only when you sell the stock. And if the stock value goes up but you don't sell it, this increase is an unrealized profit, or some call it paper gains. So if it's not obvious already, a good investment often involves buying at a low price and selling at a high price. Buy low, sell high. Of course, let's not forget that the total return for stocks or investments in general includes both dividends and capital gains. And like I said earlier, not all companies pay dividends. Take Tesla for example, the largest EV maker in the world. They are heavily reinvesting their cash for research and development, R&D, and also building new manufacturing gigafactories. And because of that, they are not paying a single cent of dividends to the shareholders. Is it a bad thing? Not necessarily, because ultimately us as the shareholders can still profit from the capital gains when the company makes more money thanks to their better R&D and production speed. And next, we also have something called bonds. They are like loans you give to a company or government, and in return, they promise to pay you back the full amount on a specific date. And along the way, they make regular interest payments to you, also known as coupon payments. So another way you can make money from bonds is by also selling before maturity date. For longer term bonds, you have the option to sell them before they mature, and if the bond's market price has gone up, you can sell it at a higher price than what you paid. It's like selling a vintage collectible for a profit. That's the same concept. And bonds are generally considered safer than stocks, but usually offer lower returns of about 2 to 4% per year. But you would wonder, why do people invest in such an asset when there's fixed deposits that can give you around 3 to 4%, right? Well, today, if you have $10,000, you can just walk into any bank to place that fixed deposit. But what if you have $10 million or even $1 billion? Surely you can't do that with a bank, right? So this is where bonds come in, and if you can see it already, it appeals more towards people with higher net worth or just companies and institutions with a lot of spare cash, and they just want to preserve their capital without losing it to inflation. You see, 3% on $1 million is just $30,000, but 3% on $1 billion is $30 million. So capital preservation is also one way to grow or preserve our wealth. And before you ask how we can quickly access these bonds, you can select from bond ETFs, US treasuries, or even simpler, money market funds. They are essentially the easiest way for you to gain exposure towards the bond market. There are tons of them around, but for those of you from Malaysia, maybe you can consider Versa Cash, KDI by Kenanga, or Go Plus by Touch and Go. And another asset that is highly popular for a lot of busy people that could, care less about building and managing their portfolio, we have something called a fund. Funds pull money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. It's similar to not putting all your eggs in one basket when investing. Imagine if you held stock in only one single company. Sure, if the company does well, then you are all good. But what if it goes south? Your entire investment will be at risk, right? So this is where diversification comes into play. By holding shares in say 10, 30, or even 100 companies, you are essentially spreading out the risk you are taking. If one company underperforms, the other performers in your portfolio can help balance the losses, leading to more stable returns over time. However, buying shares in multiple companies individually can be super expensive and involves a lot of time and also effort, and that's where mutual funds and exchange traded funds, ETF for short, comes in. With these funds, you can own smaller pieces of many companies, sometimes even thousands in one single investment, just one click. It's like diversifying your dessert tray. Instead of buying one whole strawberry cake with one single flavor, you get 10 slices of different flavors. Each slice is like a different company. So this way, you still enjoy the variety and potential of the whole cake, but with a broader range of flavors to savor, and less risk if one particular flavor isn't to your liking. And although ETFs share this key similarity with mutual funds, ETFs are traded on stock exchanges just like individual stocks, which means more flexibility because you can buy and sell them throughout the trading day at market prices. And because many ETFs are passively managed, tracking a specific index instead of actively selecting stocks themselves, they typically require much lower management fees as compared to mutual funds. And fees, my friends, are the #1 killer for most investment portfolios. Why pay more to make your fund manager rich when you can make yourself rich instead, right? Now, I know, if stocks and ETFs seem overwhelming, you can also consider investing in property. And according to a recent study by Property Guru, 53% of Malaysian homeowners are buying an extra house for investment purpose. And of course, while investing in property can indeed offer the chance to rent out or resell at a profit like I said earlier, its price appreciation often relies on the growth of the real economy in the area, location being the #1 factor. Are there offices, public transport, and of course, good food nearby? And also, population. What's the point of buying a property in a secluded area? And let's not forget about climate risk like the recurring flash floods in KL that have caused properties around the area to lose over 30% in their value. But one reason why I'm personally not a big fan of property investment is because they often require more upfront capital, like in the 5 to even 6 digits region, because buyers must pay a minimum 10% of the property's purchase price as a down payment. Of course, notwithstanding the different kind of trickeries developers can also, do to help you get 100% financing, but let's not go into that in this video. So say you want to buy a house that costs about 400,000 ringgit. A 10% down payment would mean you will be required to pay at least 40,000 ringgit upfront, and on top of that, you will need to pay for all of this. Yeah. Anyways, property is also significantly less liquid compared to other investments, meaning it will take longer to convert into cash without losing its value. So it's not an ideal investment for everyone, especially younger people with a lot more opportunities left and right. Another investment asset that's commonly overlooked by people are commodities. These are raw materials such as gold, iron, or agricultural products like corn, rice, and cotton. And similar to properties, their value is driven by factors like rarity, quality, climate factors, and they can fluctuate based on supply and demand dynamics. And there are also external factors at play like the public's faith in traditional currency systems. You see, in times of economic uncertainty or when there's a loss of confidence in a currency's value, people might just turn to commodities like gold as a safe haven, and that will also drive up its price. And lastly, of course, how can I forget? We have cryptocurrencies. This is a somewhat new player in the investment field, with Bitcoin and Ethereum being the face of it. And because it is an unproven and unregulated technology, they are inherently high risk and can be very, very volatile because their value fluctuates up and down based on how much people are willing to pay for it. Basically, it's purely demand driven. Hate to say it, and that demand can sometimes be hyped up even with a single tweet or a single post. You see, with a company stock, you are owning a piece of the company or the business that you can monitor the performance through reports and news. But with crypto like Bitcoin, etc., there's no physical thing or company behind it. So you can say that at this moment, it's still a very speculative asset, and you need to be very, very careful about that. And I can't say that enough. So if you are considering crypto, it's extremely important to research and understand the risk of the specific currency you wish to invest in. My personal opinion, of course, you can invest in every single asset out there, just that crypto is not something I particularly fancy, so it's okay to give it a pass. Just like any of the options I've just mentioned, you don't have to invest in everything just because people are doing it. Invest within your own capacity. And how to identify your capacity? Well, this is the perfect segue for me to talk about the risk versus reward of investing. You see, investing is like a seesaw, balancing risk and reward. Too much of either side will topple you. You have to know what your comfort level is with said risk, and when you have figured this out, it will shape your investment style. Of course, we don't take unnecessary risk. A smart investor always takes calculated risk. And at its core, risk in investing refers to the uncertainty or probability of your investment losing value. And yes, this could mean getting less than what you put in initially. For example, a company that you have invested in might perform poorly, leading to a drop in stock value. Or you have invested in a company that suddenly declares bankruptcy or is caught in a fraud scandal. Such events could lead to a plunge in the stock value, potentially resulting in significant losses for your investment. And the same can happen in the real estate market, not just the stock market. Say you have bought a condo in the city center thinking it's gonna be a good dividend generator. However, this year, a new condo is built right next door, offering units at lower prices. So this could, significantly impact the market value of your property, potentially reducing its resale or even rental value. My point is, other than the performance of the asset itself, there are 4 main types of investment risk that you should ultimately consider. 1. Market risk. This is the risk of an investment declining due to market factors like economic downturns or political instability. For example, even if you have chosen a company that's fundamentally strong, its stock price can still suffer if the overall economy is struggling or if new government policies negatively impact the industry. So take note on that. And number 2, credit risk. For bond investors, this is the risk that the issuer might fail to repay the bond. It's like lending money to someone who then goes bankrupt or just simply decides that they don't want to pay you back anymore. That can happen. And when you invest in bonds, you are essentially trusting the issuer's ability to repay the debt. If they fail to do so, you could lose your investment as well. Number 3, liquidity risk. This is the risk of being unable to sell your investment at a fair price and get your money out when you want to. It's about the uncertainty or the potentially longer process of converting your investment into cash. Some investments like real estate, for example, can be very hard to sell quickly without taking a loss. And lastly, we have inflation risk. Inflation in your country can greatly reduce the net return of your investment, which subsequently leads to a reduction of your currency's purchasing power. If you are not investing or if your investments aren't growing at a rate that outpaces inflation, you are essentially allowing inflation to erode the value of your money or your wealth in this context. Now, on the other hand, we have reward. In the world of investing, there's a pretty straightforward rule. The higher the risk, the higher the potential reward, vice versa. But here's the catch. It's all about what level of risk you can comfortably handle. Your risk tolerance, in other words. Think of it like a roller coaster. The bigger and scarier the ride, high risk, the more exciting the potential experience, right? High reward. But if you're not a fan of big drops and fast turns, you might not even enjoy the ride, no matter how thrilling it is supposed to be. And some might even, puke or have a heart attack in the middle of it. So it's easier to say you can stomach the risk until you are caught in the middle of it. I've been there, done that, and boy must I say, it will screw with your mind if you're not prepared for it. In fact, it's the same with your investments. It's easier to say or to see 4-digit losses in your portfolio, but if it's 5 or 6 digits and it impacts things in your life, you bet you're gonna be restless and stressed out and also second doubt your investment choices. And in most cases, people will just panic and sell at a huge loss right before the value recovers. So if high-risk opinions give you sleepless nights, in my opinion, they are not worth the potential returns. You've got to find that sweet spot, a level of risk that gets you good returns, but still, lets you sleep peacefully at night. Maybe an annual return of 5%, 6%, 8%, who knows, right? So this is where the next concept is important. Identifying your investment time horizon. It's all about what you hope to achieve with your investment. Of course, besides getting rich that's pretty obvious. Are you aiming for aggressive growth or are you more interested in steady, moderate gains over time? These goals can range from saving for a comfortable retirement 30 years later or to save up for a house in a few years' time, and this will directly influence the kinds of risks you might be willing to take. So here comes the age factor. If you are young and saving for retirement, you might be able to afford to take more risk because you have time to recover from any market downturns. But if you are nearing retirement already, say 40 or 50s, or if you have a lot of dependents like kids or parents, then you would want to ideally shift to less risky investments to protect your assets or capital preservation, like I said earlier. Whether you're looking at short-term gains or long-term growth, each period has its own set of strategies and suitable investment types. So we typically categorize it in 3 different time horizons. If you're investing for the short term, like 1 to 5 years, like preparing for an upcoming wedding, you will first need to assess your financial situation. Make sure that you already have an emergency fund and no high interest debt before you even start investing. And since you're only in it for a relatively short run, I would say go for low risk investments like high yield savings account, fixed deposits, money market funds, or even short-term bonds and treasuries. I believe these options have the lowest risk and offer the most liquidity. Plus, they are the best vehicles to preserve your capital, which is the most important aspect of short-term investing. But on the other hand, say you are investing for the medium term, like 5 to 10 years, it's pretty long, right? Like saving up for your child's primary education, or down payment for a house, then you will have a different battle plan. So for this, you can consider a more diversified portfolio that includes a mix of stocks, funds, and also bonds. Other options would include growth ETFs like the US S&P 500 index. They typically have lower volatility than growth stocks, but since you're in this for almost 10 years, it shouldn't be a problem since most stock markets have a 8 to 12 year cycle before they crash. More on this in the future episodes. And lastly, we have investments for the long term or more than 10 years. This would require lots and lots of patience and commitment to stay the course, especially during market downturns. Some common goals will include retirement planning or funding your child's university education. And for this, I would focus on investments that are typically in higher risk nature. For example, growth stocks, or heck, maybe even real estate, since the low liquidity would be easier to manage in the long run. And with the very long time horizon, you should also take advantage of retirement accounts like ETFs for Malaysians because they offer tax advantages and are designed for long-term growth, which is exactly what we are looking for. And my last tip for you is adopt a buy and hold strategy. In an economic downturn, many investors, and I say many, will panic sell their assets in order to hold on to cash just to reduce their risk and exposure. But the smart investors will just leave their money in or even buy more and afterwards benefit from the rise. Caveat of course, only if you invest in quality assets and believe they will increase their value over time. And remember what I've mentioned in the previous episode, compound interest will work to your advantage if you give it enough time. Albert Einstein once said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. And just to give you an additional take, there is a common idea that it's not wrong to have a tiny exposure to ultra high risk investments like cryptocurrency. Some financial advisors say anything less than 5% of your portfolio is a good amount. But me personally, I wouldn't even touch it because it's not something I believed in. So it's totally okay to give it a pass even though it will go to the moon, Who cares? And there you have it, my friends. I hope this video has given you enough knowledge to begin your investing journey. Help me smash that like and also subscribe button down below. Share this video to help your friends and family, and feel free to leave a comment down below if this helped you or if you have any questions. I will answer all of them. Do check out the next episode if it's out already. If not, you can also check out our playlist of investing videos to learn more about them. See you over there.